Hello and welcome to Talking Point. I'm your host, Niraj Shah. And the case for the chat today, and it's suited or fit to bill for our guest who's joining in. The case for a chat. Does the post-poll FPI flows fuel another leg of the market's rally? Is that something that people should keep in mind? He speaks to a bunch of these guys and would be able to give a great insight there. Are rate cuts no longer required, and will that have an impact on risk assets? Great to talk about multiples and rate cuts with him as well. And more importantly, he's written a number of notes on the capex trend over the last 18 months. And we now try and figure out whether private capex has begun its uptrend. Our guest today, Vinod Karki, Senior VP Equity Research, ICICI Securities. Vinod, it's been a while, but thanks for taking the time out. Hope all is well.
All well, Niraj. How are things at your end?
Touchwood. All okay, Vinod. Thanks for asking. And let's try and figure out if you believe, Vinod, since we are in the midst of the election season, whether post-election, if indeed the verdict is what the market is currently factoring in, would it make an impact on flows, on sentiment and more, or would it be status quo? Let's start off with that argument.
Yeah, so if you observe the market, once the state election results came and some of the opinion polls came, market has been kind of warming up to the idea that there's going to be more consolidation, maybe in terms of vote share, and the outcome will be favorable. So I don't think that that will be a surprise. So some of that is, I think, getting baked into the stock prices already. But nevertheless, if I mean, that's an expectation when actually there is a strong mandate, then there is a chance of some bit of what you should say, excitement in the market. It seems that the market has made some kind of up move on the expectation that we'll get a favorable mandate in this election. So to that extent, I think once the elections are out, and we have seen over the last several elections, the volatility in the markets on election day has been reducing significantly if you go from 2004, 9, 14, and that way. So I think election day volatility may not be very high if it is at par with the expectations. And beyond that, obviously, fundamentals will take over, how growth is panning out, what's the outlook for rates, and things like that.
Okay. Just wondering, I mean, the talk at the end of December, when the three state election verdicts came in, was that FPIs, which are waiting for the election verdict to come out in June or May, whatever, would prepone now because they would believe it's a shoe-in. The current dispensation is a shoe-in. We haven't quite seen that. And maybe other factors like the EM performance or the interest rate trajectories is to at play here. But I'm still wondering, in your conversations with global clients, are they waiting for the election verdict to allocate money to India, or are there other reasons around it?
Well, if you see the actions of the FPIs over the last year and particularly over the last month or so when the March numbers were available, for flows across sectors. One thing is coming out clearly that the FPIs are buying into, first of all, if you see the last year, they were more buyers of broader market than just the large caps. And even in the March month, we saw clear preference for domestic cyclicals over defensives, in fact. So which tells me that FIIs overall are very bullish on the domestic facing economy stocks. So that's a reflection of their faith and their outlook towards the domestic economy. So, but to answer the question whether they're waiting or not, I mean the action clearly speaks that they have been increasing allocation towards broader market, domestic facing economy stocks and things like that. So action speaks for itself. Obviously, there have been volatility in between when there are this expectation of rate cuts goes away and rate bond yields in the US rise. We have seen volatility around it, but overall, if you see over the last I mean, this is I think I was just looking at some of my charts and I realized that this is probably the first instance where over a trailing 12-month basis, both DIIs and FIIs are, on a trailing 12-month basis are at are buyers of 20 billion odd in terms of stock. Usually they are at opposite, they are at opposite. If the FIIs are buying at 20, the DIIs would be lower, that kind of a thing. Somehow they are converging right now. So which is, I think, resulting in these valuations remaining high. And that can actually, if the political situation gets better, growth keeps coming in, and that could be one of the reasons to be a little worried, because if both these large players in the market continue to be buyers, then who's going to be the seller? So last year, what happened was the MFs and FPIs kept buying 20 billion odd each. But the supply came from promoters and some of the other FDI, those kind of things.
Yeah.
But it's not necessary that it will follow every time. And that's where the greed comes in and everyone turns buyer, and then you get into bubble zone. So that's something I worry about from the positive side, that, if everyone continues to buy, then you get a situation where the valuations will really get out of hand.
Yeah, well, in maybe in select cases they might already have, but that's the other point, Vinod, and you've written about this so extensively, the capex and private capex as well, and I think your April note speaks about a strategy around capacity utilization levels as well. Just trying to understand what's your thesis now. Some people argue that don't look at bank credit growth as a proxy for private capex, because capex is happening without bank borrowings, and therefore don't look at that barometer. Capex is happening in a lot of sectors which hitherto had not seen capex but are seeing capex. I would love to understand from you, one, is government capex still as strong as it was? Is that the only factor driving capex spends? Or is private capex also starting to rise? And what are the pockets where you're seeing telltale evidence of this?
Yes, so when you talk about capex, so the investment rate is on the verge of breaking out of the previous high of around 34% of GDP, which was made in around 2011-12, and this time with better ICOR, so which is the productivity of capital is improving, and that I can substantiate that macro number by the ROE of the Nifty, which is getting into value creation zone of more than 15%. Now, when you talk about an investment rate of 30% plus, which you're effectively talking about more than 100 trillion rupees worth of capex, because the GDP is around 300 trillion. So when you break it up, what does government contribute? Nothing. I mean, it's just 8-9 trillion from the center and 7-8 trillion by the state. So it's 15-16 trillion. So where is the rest, which makes up more than 100 trillion, coming from? That's what I mean. If you look at the GDP print every quarter, it is showing that the gross fixed capital formation is leading GDP growth, which means that a large part of the GFCF, which is made up by real estate investments by households and corporate capex, must be moving. What we know anecdotally and from data is that real estate cycle is almost in the second year of its expansion. While the center was doing pretty well, now states have started to contribute from this year, and they're growing faster, I think, than the center. And corporates, I think, are just about starting to pick up, in my view. Right? So if you look at the evolution of this investment cycle this time around, the first move was made by the center in terms of expanding its investment. Real estate followed on its own in terms of animal spirits somehow rose and people started buying houses, and it's continuing. Typically, these cycles last from 5 to 10 years. And now states, because their revenues have started rising, they're getting better stamp duty, GST and things like, they have started contributing. Corporates, I think, have just started to bottom out and started to rise. So there is this biggest lift may come from the corporate side in India.
Got it. Okay. Well, the other aspect, of course, is what's happening to specific pockets and, by virtue of this capex, what PSUs have done. Actually, speaking of PSUs, just before I get to Vinod on that, can I get in my colleague Mihika? Mihika joins in right now to talk about a big development that's happened in terms of a policy decision, really. And it may be an isolated instance, but Mihika, GSPL is a stock firmly in focus today for all the wrong reasons.
Yes. So they have gotten a 47% tariff cut from the Petroleum and Natural Gas Board, and this is for their key high-pressure pipeline network in Gujarat. Now, the authorized tariff is at 18.1 rupees per MMBTU versus 34 rupees earlier, and this is also lower than the 51 rupee tariff that was originally sought by Gujarat State. Now, in terms of impact, while consumers could see lower prices both on households and industrials, for Gujarat State Petroleum, it puts a pressure on their revenue and their profits, as because this is a cut on the price they can charge to transport the gas via their pipeline. Now, there were many reasons for why the Petroleum and Natural Gas Board did cut the tariffs so drastically. One is higher volumes. Their volume assumptions, while Gujarat State Petroleum assumed 26 million metric standard cubic meter of gas per day, the board assumed 31.7. In terms of capex, their capex assumption stands much lower. Now, Gujarat State Petroleum claimed a capex of 3,400, while the board considered 1,800 crores. And in terms of low operating capex, the PNGRB approved 2,600 crores of capex, operating capex, while the company stated 5,000 crores. We also had certain brokerages that did go negative in terms of rating and their price targets. We had Nomura, which downgraded Gujarat State Petronet to a reduce at a 320 rupee target, which implies a 15% downside to the previous close. They've cut FY25 and 26 EBITDA estimates by 37 and 42%. And lastly, we had Kotak, which also reduced its rating to a reduce at a target price of 360 rupees, which is a 22% downside.
Got it. Mihika, thanks a lot for that. And that clearly makes GSPL the stock of the day today. And Vinod, PSUs seem to have shrugged off this cloak of what could happen if there is an action X or action Y taken. Periodically, some regulatory action on PSUs or private companies, but impacting a lot of PSUs companies comes to the fore. Just trying to understand, for gas companies or for PSUs in general, are you constructive or would you approach them with caution now that they are no longer at dirt cheap valuations?
So if you look at broader economic cycles, what we observed is that, see, PSUs, why are they performing? You have to understand it is coming from the way the color of the economic expansion is happening. As I said, investment rate is leading the GDP growth. So what happens in this environment is that companies which grow by growing their balance sheets and investing, they do well. And bulk of the PSUs are in the capital intensive sector. So what will happen is, as the investment rate is expanding with better productivity of capital, generally these companies will show better than expected growth. And that is what the market cares about. I mean, one or two instances where regulatory, because of regulatory reasons, you will have cut in estimates and things like that. What the investor has to be cognizant of is that stocks perform wherever there is growth surprise, So we continue to believe that in the way the economic expansion is happening, bulk of the companies which are in the related to the investment side of the economy, they will continue to show better than expected growth in general. I mean, you'll have cases where regulatory concerns will dilute the picture, but in general, that's the thing we think will show up. In fact, disappointment is continuously coming from the outperformance of the previous cycle, which is the defensive sectors, be it IT or even FMCG. And in general, FMCG is getting into a situation where the broad-based consumption, the low-end rural consumption and things like that continue to struggle. While the valuations, if you see, if I were to put a PEG ratio, PE to G ratio, they look pretty expensive. So do IT, which we have been saying. Obviously, at some point, they'll get into a good zone and growth will kind of bottom out and start looking better. But for now, the growth is firmly on the side of the cyclicals, which, as I said, FPIs, DIIs, they continue to be positive on, continue to buy these stocks.
Well, what's the view on IT? Actually on IT, maybe what we do is, just take a quick break because we need to take a scheduled commercial break. Just take a very quick break, come back, talk about IT. In fact, maybe try and get in my colleague Rucha to just make a quick comparison as well. But talk to Vinod Karki about IT and then talk to him at length about cyclicals. Where is it that he finds favor? Stay tuned. We'll be right back.